Hi, I'm Scott, and I would like to welcome you to the Wealth Tax Topic Lecture on the 2024 November-December Lincoln-Douglas Debate Resolution. This topic lecture is meant for everybody, whether you are a progressive debater, a traditional debater, whether you debate nationally, just in your state, or just locally, there is something in this video for you. I highly suggest that you use the timestamps in the description below because this video is exceptionally long. I'm recording this after I've done the video, and I can tell you it's over 2.5 hours long. The reason for this is threefold. One, there's robust literature for pretty much every angle, every style, every meta, every type of content and form that debate uses. This topic has a really robust literature base that the more and more I researched, the more and more I just had stuff to say. The second thing is that taxes are just really complicated, and there is a lot of background information that is required to talk about a wealth tax. Finally is probably the most important thing is that for traditional debaters, this is going to be one topic where your judge is probably going to know more about taxes than you know about taxes because most adults have that core knowledge as a part of the skill set that they have in life. If we look what this video is going to include, it will have different definitions, we'll break down what taxes are, we'll go down the background, the history of taxes, and the history of wealth taxes, and then jump into the substantive debate arguments like value criterions, philosophies, different affirmative and negative contentions, and then more progressive arguments like counterplans, critiques, and critical affirmatives. So I really hope that you like this video and find it helpful, and I look forward to seeing you in a future video. Thank you. The exact wording of the 2024 November-December Lincoln-Douglas debate topic is resolved the United States ought to adopt a wealth tax. Before I look at the different key terms and definitions of these key terms in order to break down and interpret this resolution, I want to talk about what type of resolution this is. I think that this resolution, because it has the United States as an actor doing something, is likely a claim of policy. What this means is that unlike a lot of Lincoln-Douglas debate topics of the past, I think a lot of people are going to look at this from a more policy debate perspective in terms of what the net benefits are there disadvantages to this. But that being said, I think that there is also an incredible amount of value criterion, philosophical ground on this topic. But just to note, this resolution on face seems like a claim of policy, and I think a lot of teams are going to debate it as such. When we look at this topic, one of the things that you'll note is this is probably one of the shortest topics in length that we have had in Lincoln-Douglas in a hot minute. Some of the key terms are very similar to resolutions that we've had in the past. So United States and ought we've had in the past, but adopt is not something that we have seen, and wealth tax is very interesting on this topic in terms of whether or not you are going to define that individually or define that as a whole. And I think that that is going to leave up a lot of room for interpretation on this topic in terms of different definitions. If we look at the United States and ought, I think this is going to be very similar to past topics where it's probably the United States federal government, especially because it is talking about sort of this wealth tax policy that we have seen a lot of federal politicians talk about. But I also think that there is a good case for a lot of states and local actions, which I'll get to in a second, because taxes work at a bunch of different levels where there are federal, state, and local taxes that all operate different and independent of each other, but interact with each other. I think that ought means that there is a moral obligation. However, I think that because this is a claim of policy topic, that a lot of people are going to say that this has less to do with morals and more to do with the should. I think that people are gonna kind of view this as a policy debate resolution. I think that one of the reasons for this is that when you look at the word adopt, it has a very legal definitional backing in terms of meaning a law or a legal obligation that forces the government to do something. So I think that a lot of teams will probably talk about the implementation process, how that is done, what the different parts to this wealth tax law would actually be, because I think a lot of teams are going to define adopt as meaning some type of legal language. I think that there might be some moral grounds to this, but I think on the whole, I think that a lot of teams that look at this resolution will probably look at it from a policy or legal standpoint. I think when we look at the definition of wealth tax, that this becomes a lot more complicated and is really hard to do in the beginning of this video because it takes a lot of understanding in terms of how different tax laws work, what different types of taxes there are, and all sorts of different knowledge like that that you probably don't have, or at least don't have a very complex, diverse understanding of all of these tax law things, because it's not something that is typically taught in school, and it requires a lot of knowledge in order to understand how all of these things operate. But before I get into all of that nitty-gritty detail stuff, I just want to start by saying that the topic says wealth and wealth tax. It does not say net wealth, net worth, federal worth, national worth, global worth. I think that when you define a wealth tax, that a lot of people are going to look at these policies definitionally and say that that's what a wealth tax would do. So I think, for instance, we will talk about Elizabeth Warren's wealth tax policy, and that policy defines what wealth is. And I think that that is going to be important because while I have up here that it says that wealth is all assets, I have seen some definitions, which I'll talk about in the topicality section, that say that it would be some assets, which I think would open up the ground for a lot of planned affirmatives. However, if we look at this really simplistically, I think that the wealth tax or a wealth would apply to all assets that somebody has. The general premise behind this topic is that wealthy people have a lot of wealth that they do not pay tax on because they do not necessarily have that wealth in liquid income or wages that come to them. The topic of a wealth tax would say we would tax those things that are not being taxed right now. So for instance, if somebody has a lot of stock, that stock doesn't get taxed every year. It only gets taxed when it is realized. That is a word that is really important that I'm going to talk about a lot and define in a little bit. But the basic premise for this is that you only pay taxes when your gains are realized. So when you get wages, when you have income, when you have an inheritance, when you have property, when you, all of these types of things. But what's not taxed are unrealized gains. So if I have 1,000 stock in a company and it's worth $1, but then it goes to $150, my net worth is a lot more, but I don't have any, money. I don't have any liquid assets. I don't have any money in my bank account to account for that. So the US tax system is set up generally around realized gains. And what that means is it looks at your actual profits when you take those profits. I'm going to stop here. I'm going to explain a lot more of that to come. But what I want to do now is I think that when we definitionally look at this topic, the most important word is probably tax. So I'm going to warn you right now that in the intro, when I talked about using the timestamp features below to go through and look at the different parts of the preview and table of contents, that the next big portion of this video is going to explain how taxes work and give you a basic introduction to all of these different aspects to taxes. I thought that this was important to forefront this information because it's really impossible for you to understand a lot of the rest of the video if you do not have a basic understanding of all of the different taxes and the structures for how taxes work within a federal and state tax system in the United States. So I highly recommend that you watch this portion, but if you think that you are like a tax attorney or an expert or something of that nature and you just get everything, you're more than welcome to go ahead and skip down. But I highly recommend that you stick around for this next portion, or at least put on like 1.5 speed, because I think that a lot of these concepts are going to be extremely important for how people discuss a wealth tax, because the wealth tax operates with an independent and with all of these different taxes. So without further ado, here's Taxes 101. Welcome to Taxes 101. I'm your host, Scott. No, I'm joking. I want to start with talking about taxes, and I really thought about making this its own separate video that was just kind of like a precursor to the wealth tax topic, but I thought that it was impossible to understand this video if you don't understand sort of all of the basic concepts that I am about to talk about. So if we look at a tax is at a very simplistic level a compulsory payment to the government. In the United States, taxes are paid at a federal level, at a state level, and at a local level. But these taxes are uneven in the sense that certain taxes go to certain people or certain governments for certain things, but don't go to them for other things. However, what do you get for this tax payment? If you look at it, you really get nothing in particular, but in reality, at least in terms of the federal government, the tax money that you send to the government, or that all Americans send to the U.S. government, is the revenue or the main source of revenue for the government. And the government, in terms of the revenue that it spends, 20% of that goes to the defense, the military, 25% of that goes to different healthcare related things, 20% goes to Social Security, and the rest gets split up a bunch of different things, including public assistance, infrastructure, and things of that nature. Now, this is different at the state level, or the local level, where you have property taxes that are spent on things like education, but at a federal level, which is what I think a lot of people on this topic are going to talk about, these are the main sources that your taxes go to. Now, if we look at actual taxes, I want to group taxes into 3 general categories. These categories are consumption taxes, income taxes, and taxes on your assets. You can essentially look at consumption taxes on things that you buy, income taxes on income that you earn, and assets are on things that you own. One of the things that we are going to look at as we go through these different types of taxes, because this is a really important term on this topic, is the tax progressive or is the tax regressive? Basically, this means, is the tax progressive means, does the tax take a larger percent of income from higher income people than it does from lower income people? So if a tax is 10% for somebody who's low income, but 25% for somebody who's high income, it would take a larger percentage from the person who is high income. So therefore, it would be a progressive tax. Regressive would be the opposite of this. I don't want to spend any more time there because I'm going to talk a lot about this as I go through the different types of taxes that are underneath of these categories. But this is a very important concept because a lot of the wealth tax literature is going to use this language and lingo to describe whether or not taxes are beneficial or not. So if we look at consumption taxes are pretty simply put on things that you buy. The biggest example of this is a sales tax. A sales tax in the United States right now, there's no federal sales tax, and that is only done at a state or local level. So some states, like California, have a really high sales tax, where other places have no sales tax. This depends on how your government chooses to generate revenue. An excise tax is a tax on a specific good. You'll note here that I noted that it's regressive. The reason for this would be, well, let's use an example, the gas tax. So there is a federal gas tax that is 18 cents on the gallon. If I am rich, that 18 cents on the gallon affects me a lot less than it does somebody who is poor, because somebody who has a low income, that 18 cents matters more to their budget than it does to somebody who is rich, because that 18 cents doesn't matter. One of the things that's important to note about the gas tax as well is that some states like California tax gas a lot more, which make those taxes or make your gas a lot more expensive. Another type of excise tax that is pretty well known is what is known as a sin tax. So for instance, tobacco and alcohol, because they are viewed as sins, are taxed more underneath federal policy. So tobacco, the federal tax on a pack of cigarettes essentially equates to $1. This would be another example of a regressive tax, because somebody who's high income that buys a pack of cigarettes would pay less of their money for this flat $1 tax than somebody who's low income. I think that another example, at least at a state level, of a sin tax would be marijuana, where in states like California, you have these taxes fund different aspects of society, and you fund them at a much higher rate than normal goods because they are viewed as quote-unquote sins. So that is consumption taxes. Let's jump over to income taxes for a second. Income taxes are event-driven. Remember, before I used this term realized, this term is really important because that is the moment when your tax obligation is generated. If I am Elon Musk and I own 100 million stock in something and that stock goes up in price, I don't pay any tax on that. The reason for that is that that is not realized yet. That income has not turned from stock into actual liquid money. We'll get more to that in a second, though. If we look at income taxes at a federal level, federal income taxes are done progressively. What this means is they are bracketed so that low-income people pay a lower percentage of their income than high-income people pay. So you'll note here there's a lot more steps than I put up here, but here are some general examples of steps, and I forget what year, but it was just a good example of how different tax brackets work. Now, federal income tax, everybody has to pay, but at a state level, it depends on your state. So some states don't have an income tax, and that makes those states seem really nice for people to move to who would have a lot of income, because they wouldn't have to pay state income on that income. Whereas in a state that has high state income taxes, like California, you would have to pay a lot of that income tax. Now, what I want to talk about for a second is, let's say, given this example, I make $50,000 and I have to pay 22% of my income in taxes. The federal government, the state government, it doesn't really work the way that you give them a check for 22% at the end of the year. The way that it works is that most employers do what is called withholding. And what this means is that if we look at a paycheck, you will notice that in this paycheck example that I have here, for somebody who makes $1,000, that they had $159 taken out for federal taxes out of their paycheck, and that money is withheld from their paycheck. It's taken from their paycheck and is going to go towards their tax bill. The same thing is true for the California state tax, because that happened to be the specific pay stub that I got for this example. Now, one of the things to note is that the idea behind this is that when tax time comes, so the way that taxes work in the United States federally, the tax date, the tax season starts January 1st, ends December 31st. The way that this works is that money is taken out and accrued throughout all of your paychecks, and then the idea is that if your employer is taking out enough money, you will not have to pay any federal taxes at the end of the season when you have to pay them. Generally, taxes are due around April 15th every year. Tax day can depending on if it's a weekend, things like that, but generally April 15th, around that day, tax day. When you have to pay your taxes by that date, the idea is if you get them withheld, it's a lot easier for that to be done. Now, one of the things you'll note if we look at this paycheck is that there's things that are deducted out of the paycheck other than those taxes. If you look at this specific paycheck, there is something called payroll taxes. So this happens for every employee who receives a payroll paycheck like this. And when you get your paycheck, money is taken out, 6.2% for Social Security and 1.45% for Medicare. These are different from taxes, or they are a type of tax. They are different from your income taxes and only are taxed on wages that you are receiving in your payroll. One of the interesting things to note about this is that the employer also pays these. This is a matching fee, but I just wanted to stop off here for a second because taxes are a lot more complicated than you make them think. I also think that this is an example of a place where people might go like increasing payroll taxes rather than doing a wealth tax. But a payroll tax would be a type of income tax. Now, if we look at income taxes, again, income taxes are event-driven. It is a taxable obligation when income is realized. So the example that we just had, when you receive a paycheck, you get liquid money. That means that that income is realized. The way that this works is really important for the capital gains tax, which is a separate type of income tax, which you get from the profit from the sale of an asset. And your tax obligation is only realized, your tax obligation only happens when you have proceeds from the sale of that asset. Before it is taxed, before that asset is sold, there are zero taxes. Before it is sold, it is what we call unrealized. The sale is what realizes it. I'm going to talk a lot more about this and give a lot of examples in a second, but this is really important because what it does is it allows unrealized profits to stack up and accumulate without being taxed. Now, if we look at this simplistically, what this basically means in terms of realization is if a taxpayer has not sold something, there's no income. If there's no income, there's no tax. If there is income, there is a tax. If we look at this specific federal capital gains tax, one of the things to note is there is a difference between short-term and long-term capital gains, and this is also taxed progressively and just depends on your income bracket. Generally, most people pay around 15%, which you'll notice is a lot less than people's income taxes for this. Now, the last type of tax that we are going to talk about are asset taxes. The first one is a property tax. There's no federal property tax. This is only something that is done at the state and local level, and this generally only applies to real estate. I really would implore you to think about this as kind of like an upper middle working class wealth tax, because most upper middle class working people, their main asset, their main source of wealth is their house. So these annual property taxes that they pay are a form of a wealth tax on those types of people, homeowners. Now, one of the problems with super wealthy people is that their homes are a lot less a part of their wealth. So that property tax doesn't tax their wealth the way that it does an upper middle class working family. Now, one of the things to note is that different states have all sorts of different rules for how you allocate these things. Is it only done to the local level, the county level? Where does it go? All sorts of things like that. But generally, the number one thing that's associated with property taxes is education. A lot of public education budgets come from these property taxes. At a federal level, there is something that is known as the estate tax. When you inherit something from a relative who dies, when you get a gift from somebody, those might even be viewed as wealth taxes, but just to note that there are some types of asset taxes at a federal level. If we go back and look at all of these things now, if we look at these consumption taxes, income taxes, and asset taxes, I started by just grouping it as consumption, income, and assets, but when you look at it, I think that this is how you would classify all of these things. I might be wrong. I might be correct. I think one of the things that is really hard about this topic is that taxes are really, really complex and uneven. So there might be different types of taxes within these things that might even change the categories for how we classify them. I think that the more important thing that I want you to think about is the wealth tax, and would that tax be progressive or regressive, and how would that impact how the actual policy is implemented. The one thing that I do want to do before I end this kind of taxes 101 part of the lecture that I've been droning on for now is talk about some other types of taxes. The corporate income tax is a flat 21%, but based on this, and this is kind of jumping ahead, but if we look at a specific policy, the Massachusetts millionaire tax, this is a tax that might tax wealth, but it is not a wealth tax. The reason for this is that it just adds a 4% surtax onto your income. So if the state income is 8%, you pay 12%. New Jersey and New York have very similar policies. Now that you've kind of gone through this whole thing, you might realize that if a wealth tax is a tax on all assets, maybe this is not inclusive of that because income is generated separately from that. Or maybe it's not. Maybe it's two taxes. Maybe it double taxes. I think that these are interesting things and concepts to think about. There's all sorts of other taxes that I could never cover to sort of make this video short, but I think that, a lot of people might try to talk about jock taxes. That would be taxes on professional athletes going from places to place. I'm not sure that this would be a part of the topic. There's other types of taxes that have existed but now no longer exist, like poll taxes, which were taxes that were paid when you voted. But I think that one of the things to note is that this is a very, very brief summary. Somebody else who gives this topic lecture might completely disagree and start very different. They might start with the history of taxes, which I'm going to do later in terms of who gets the power to tax and all of those certain things. But the thing to note is that taxes are really, really, really complicated. I'm sure I made some mistakes talking about taxes on YouTube for 17 minutes or however long this section is. But I think that that is important to note for this topic because taxes are really complicated. They're uneven. There's all sorts of exemptions. Maybe a family files differently. If you have dependents, there's different rules. You get tax credits if you have an electric car, if you have earned income, maybe you have different write-offs from charitable donations. There's all sorts of things that make this puzzle piece picture of taxes really complicated, but I really thought that before I get into the actual nitty-gritty what is a wealth tax, that this was really necessary to understand how this topic works from a basic perspective. So hopefully you've hung in with me and you've thought that this is helpful. Now I want to turn the wheel back over to the actual wealth tax topic. Finally, going back to the wealth tax topic and wealth taxes, I want to talk more about defining wealth taxes and giving some examples, kind of the reverse of how I've done this in the past, where I start with history, because I think that this general background and how wealth taxes work is going to be very important for you to be able to understand everything that's to come. So a wealth tax would tax unrealized gains. This means it would tax all of your assets, not just the assets that are in your bank account or that are liquid. So we talked about just previously that income taxes generally tax your earnings, where a wealth tax would tax all of your assets. The general idea for a lot of this is that the unrealized gains that a lot of wealthy people, who the target of this topic is, have unrealized gains in either stocks, bonds, or privately held companies. For instance, if we look at some of the richest billionaires in the United States, like Jeff Bezos, he is worth $200 billion, but a ton of that money is in unrealized shares that he has yet to pay taxes on. The same thing is true for almost every billionaire that we have in America, and there's a ton of different examples of this. I think that the greatest way to explain the difference and how this works is the example of Mark Cuban. If you don't know who Mark Cuban is, he's on Shark Tank, used to own, kind of still owns, the Dallas Mavericks. So Mark Cuban bought the Dallas Mavericks in 1999-2000 for $280 million. He recently sold the Dallas Mavericks for $3.5 billion. If you look at how much gain he realized from this, it was like $3.2 billion. The way that we look at this is we take the amount that he sold it for, we subtract the amount that he bought it from, and that is the capital gains that he was realized. We know that amount because there's record for how much he sold it for, how much he bought it for. The government knows that, and they can tax that. A wealth tax would add to this a 2%, let's just say for a random example here, 2%, a 2% tax on his basketball team, the Dallas Mavericks, every year. So that would be an example of how the wealth tax would work. The question is, which we'll get into in a second, is how do you value that? Because we have a really good way to value things when he bought and sold the team because there was a liquid transfer of gains, whereas who knows how much that is worth every year, and it can kind of vary. And I think that's what makes part of this topic really hard to navigate for both sides. So if we look at this, I want to look more, we talked about unrealized assets. I want to talk more about what these assets would look like. So generally speaking, again, the wealth tax would be a tax on all assets of an individual and a house. Now we'll get to this in a second, but this is important definitionally to note because a lot of the brackets or money numbers that you see is actually for a household or a family, not for an individual. And an individual would actually be half of that, which is interesting to note. But if we look at a wealth tax, a general way of thinking of this is it's an annual tax that's levied on the net worth of a household or an individual. Some of the things that could contribute to that net worth would be bank accounts, bonds, stocks, mutual funds. Now, obviously, for stocks, for mutual funds, for bank accounts, those things are really easy to be able to calculate the sort of value of. It's harder to do that for privately held companies, which I'm purposely excluding here. We're going to get to in a second, but that would definitely you could list that in either one of these we could talk about, probably non-financial. If we look at non-financial assets, those things would be things like real estate, luxury goods, family heirlooms. There's all sorts of different terminology and language depending on which plan, which policy, which type of wealth tax, who wrote the wealth tax policy that you're specifically reading cards from, are going to have different ideas of what is encompassed underneath of this net worth. But basically the idea is every asset that a person holds. Now the important part, I think, is up here above a threshold. What does that mean? Well, let's use an example of a wealth tax policy to talk about how this would work. So if we look at Elizabeth Warren's original wealth tax plan, that tax plan was a 2% annual wealth tax from $50 million to $1 billion in net worth and 3% above $1 billion. The way that would work is that from 0 to 50, there's no tax. From 50 to 1 billion, 2%. In excess of 1 billion, 3%. What that means, though, however, is that somebody who's worth $55 million pays 2% on $5 million. They might only pay $10,000 or whatever that math is in a wealth tax because they're just not that far above the threshold. Whereas somebody who's worth a lot more would pay a lot more in wealth taxes. However, note the first million or the first 950 million would be taxed differently because of the way that the different thresholds for this works. Now, I want to talk about, we just sort of gave this example using Elizabeth Warren's plan, but there's lots of different people who have lots of different ideas for what a wealth tax would be. And I want to talk about this and go off and talk about different wealth tax plans now, because Elizabeth Warren actually changed her plan. So her plan was originally 3%, like a 1% increase if you are worth $1 billion, but it has now increased to be an additional 4%. So that amount over $1 billion would now be taxed at 6% under her plan. And she also has mechanisms that are in place that come with the wealth tax that are like anti-evasion, avoidance, detection measures, which I'm going to get to later in the video, but might be really important for the affirmative to talk about. If we look at Bernie Sanders' plan was different from Elizabeth Warren's in the sense that his threshold was lower. It started at 32 million instead of 50 million. You'll also note that Bernie's plan was halved for single people. So I could be wrong about this, but I'm pretty sure that the number listed over here would be half of that if you were a single reporter of those taxes. You'll note we've talked about in the Taxes 101 section about progressive taxes and regressive taxes. This is a great example of a progressive tax because as you have a higher income, you pay more money in that. You will also note here that different states have had conceptions of a wealth tax. I don't think any of the wealth taxes here actually were implemented, actually happened. Like I know the one in California failed, but I just wanted to put these up here to note that there's lots of different ideas. Is it a high percent? Is it a low percent? Is it a low threshold? Is it a high threshold? The thing that I wanted to end this tax plans portion talking about is that when you define wealth tax, some of these policies are very specific in taxing worldwide income versus just income in the United States to try to be able to capture the full magnitude of that wealth to be able to tax as much as they possibly can. Now, one of the things that I want to talk about is while the states here have really low numbers in terms of what a wealth tax would look like, we might consider that a moderate wealth tax. Whereas there is a lot of literature that talks about a more radical wealth tax, taxing rich at a much higher percentage rate. And there's a lot of interesting literature that talks about how lots of billionaires would still be billionaires, but it's harder to remain a multi-billionaire. So certain people like Mark Zuckerberg would still be worth many billions of dollars because his net wealth growth is astronomical. The same thing would probably be true of NVIDIA's founder right now, whose growth is like at 110%. So he would be able to maintain paying that tax, whereas somebody like Bill Gates would only be worth $4 billion today because that radical wealth tax would have taken so much more of his income. If you are interested in this, there's a really good article that I have a quote here from that talks about if you had implemented this policy in the past, how that would have had an impact on inequality. The reason lots of people choose 1982 is that that's when you see a big driving gap between wealth and equality get larger and larger and larger. But the general premise is behind this is that billionaires would be a lot less well off, which we'll talk about in a second. But I want to stop off and talk for a minute about this Biden-Harris billionaire minimum tax plan. A lot of people call it a min tax. I want to talk about this because I'm not sure it's a wealth tax. Maybe it is. I don't know. Drop a comment if you think it is. Have an argument. But I think that it is a income tax, not a tax on all of your assets. So if you think that a wealth tax can be some of the assets, maybe it's a part of a wealth tax. But the general premise on this tax policy is that if you are worth over $100 million, which is colloquially known as a centimillionaire, that you would have to pay a 25% minimum tax on all of your unrealized gains. Now, one of the things to note that's makes this topic interesting is this is not that many people. There's only like 10,600 centimillionaires in the United States to begin with. So this wouldn't impact that many people, but this could certainly be part of a wealth tax because taxing unrealized gains, as we've been talking about, is a giant component to how a wealth tax would function because it would tax stocks and public companies and different ownership interests, generally speaking, in companies that haven't been realized yet. I think the reality of this, if we look at this is really, really a high rate. Like if we go back a couple slides, Bernie was at 10%. I think 25% is really, really high and kind of unrealistic. If we look at a graph of how this would work, again, you can check out, it's the same article that I was talking about for a radical wealth tax, but you'll notice that this is a graph that has the share of wealth owned by the Forbes top 400 billionaires. And if you look at this, it shows the impact on their wealth that these different rates of a wealth tax would have. And I think that this was really key to me kind of looking at this and being like, oh man, 10%, I'm not sure I would want to say that because that seems like a really big hit, whereas maybe 1%, 2%, 3% seems like it might generate more, political willpower while still maintaining a lot of the things that wealth does, which we'll talk about on the negative side of this. But on a more radical side, you'll notice that a radical wealth tax, if we really tax wealth, the wealth tax is very, very good at eroding wealth because if it's at a high enough percentage point, it's very hard to generate gains or growth that is higher than the amount that you are being taxed. I think that a really good way of thinking about this, I'm going to talk about in a second. Let me stop off and talk about this for a second. I think that a wealth tax would be really hard for us to think about. If we go back to the current system based on realization, the reason why it's so easy to tax things is the government knows how much money to tax. When Mark Cuban sold the Mavericks, they know he netted $3.2 billion realized, and that's his tax bill. They also know because he sold it, he has all that money and can afford to pay the tax bill. The problem with taxing unrealized income is that it's hard to value. So for instance, if we use David Stewart, for example, who is the richest black billionaire in America, he owns 59% of Worldwide Technology. That is a private company, and that is a large majority of his net worth. How do we value that? Do we take his word at it? Does the IRS have adjusters? How do we value that? The other thing that would make the wealth tax difficult is, unlike Mark Cuban, who sold the team and has the assets, David Stewart just has stock in Worldwide Technology. So in order to become liquid, what does he have to do? Does he have to sell stock? Does he put stock in a trust that the government holds until he pays his eventual tax bill in selling the company stock or the private company? I don't know how that works, and I think that this would make this topic really difficult to actually actualize from an affirmative perspective without getting into a lot of nitty-gritty details for how this works. So as an example, I just think it's hard to value. If we look at not just David Stewart, but all Americans who are billionaires, it's really hard to value because 62% of the wealth of the 1% is private businesses and non-financial things. How do you value that? Who does that? Again, they're not liquid. These billionaires have stocks. They have companies. Like, sure, we can look at the face value of a Facebook stock or a Meta stock and multiply that by how many of those shares Mark Zuckerberg has and come out with a number for his tax bill, but that's much harder to do if you have a private company. I also think that all of these forced liquidation things would be very interesting, and I'm not sure how they would work. Everybody is probably going to have a different way to deal with this, but I think a good way of thinking about this is an example that I saw from this article that used a hypothetical California tech founder as an example. If he would own 100% of a company that was valued at $6 billion, if he had to pay Elizabeth Warren's wealth tax bill, he would need to pay a $300 million wealth tax payment, but he's not liquid. Like, the David Stewart example I used for Worldwide Tech, all of his net worth is likely in this privately held company. He has no cash. How does he get that cash? Well, the way he gets that cash is through raising money. Or how does he do that? He has to sell his stock. When he does that, he has to sell way more than $300 million worth because he has to pay taxes on that. And that's just 1 year. So in order to pay, at least underneath the math of this article, that wealth tax bill of $300 million, he'd have to sell $1 billion in stock. If he did this year after year after year, like an annual wealth tax would have, that would equate to like over 60% of his wealth. It would really erode his wealth, but it would also make it so that company is no longer really that founders. It's not really in their interest to do this anymore. Now, these numbers are a little different because they assume higher capital gains taxes and all sorts of things like that. But I just thought that this is a good example of how this would really work in terms of liquidity and things like that. Now, one of the things to note before I talk about the history of taxes and wealth taxes is that the way that a lot of people get around this, you might be sitting here like, oh, well, then how does Jeff Bezos have all this money to do all this stuff? How do these billionaires have all this money? And the answer to that is that generally the banks let them loan against their stock prices. But we will get to that in a minute. Hopefully that was helpful in terms of how a wealth tax would work, the different plans, and now I want to talk about the history of taxes. I am going to break the history part of the topic lecture into two different components for this topic. First, I'm going to talk about the history of taxes in general, and then I'm going to talk about the history of wealth taxes. If we start with the history of taxes, especially in the United States was founded as a rebellion against British taxes. That's part of how the United States started, and a regular tax on income or wealth does not appear in the United States Constitution. What does appear in the Constitution is in Article 1, in both Section 2 and in Section 8, there are different parts of Article 1 that say what the Congress's power is to do a tax and to not do a tax. There's also the 16th Amendment, which I'll get to in a second. But the thing that is interesting to note, especially if you are a critical debater, is that Section 2 of Article 1 for taxes is also the 3/5 compromise, or a part of the 3/5 compromise. So I think that there is definitely a racial component to taxes and how taxes work. But that aside for a second, if we look at the history of federal taxes and the revenue, again, remember the point of taxes is to generate revenue for the government. The way that the federal government generated revenue was through tariffs. Tariffs are a tax or a customs duty on goods that are imported or exported. For the most part, up until World War I, generally the revenue the federal government used was from tariffs. Now, there were other types of taxes that were done at a state level. So, for instance, the capitation tax, also known as the poll tax, which was a tax on your ability to vote, which has since been abolished by the 24th Amendment. There were also different general property taxes, which I'm going to talk more about on the wealth tax history part, but there were different ideas of taxing livestock and land at a very, very, very minimal rate. But up until the introduction of income taxes, largely excise taxes are what funds the federal government and are its main source of revenue. If we look at the actual history of the federal government trying to get its hands on money, we have the Civil War Revenue Act. This was a temporary act that was meant to get income for the federal government. It was when the IRS was created, and this was the first national income tax created in order to try to support the Civil War repealed later. There is a 1984 tariff that the Supreme Court strikes down, and this is interesting to note because this sort of set up the idea for the 16th Amendment, which in retrospect and after that case was struck down, the 16th Amendment was passed by Congress in 1909, ratified in 1913, and income taxes come shortly after that because Congress was then allowed to levy an income tax against the citizens of the United States. The thing that I want you to think about that's really important is, why does a country raise taxes, or why do they increase taxes? You're about to look at a bunch of charts. The reason that they try to get tax revenue or taxes is for revenue. When do they do this? The two biggest reasons why a country would raise taxes, have taxes, increase taxes, would be for periods of war or for periods of economic uncertainty. So if we look at the history of income taxes, this is just income taxes, you'll note that the graph goes up and down for the highest rate that income was taxed at. Now, you'll notice this isn't everybody's tax rate. We're going to get to that in a second. But you'll notice during World War I, during World War II, during the Great Recession, Great Depression, there's all periods of time where the tax rates are increased in order to deal with different economic or conflict war-related scenarios where the government needed to generate a bunch of revenue. On the flip side of that, you can definitively see a point on this graph where President Reagan was elected. So there's all sorts of different ideas of when a tax is useful over the course of history. Now, what's interesting to note is that not everybody was paying a tax during this time. If we look at 1918, only 15% of Americans were even paying income taxes to begin with, versus today, where I believe a majority of Americans pay an income tax. Now, income, not the only way the federal government generates revenue, not the only way it has taxes. I thought that this graph was also pretty interesting because it has the idea of a corporate tax, a capital gains tax, a different rate for dividends, and how that is taxed comparatively. However, if we go back to the revenue that the government generates, you'll notice that the federal government is generating more and more and more revenue over time. In 1913, only 300,000 people filed a tax return versus in 1946, after World War II, where 50 plus Americans filed a return for the first time. The reason for this is that the government needed more money from more people in order to fund the war effort. Now, this has just kind of become regular circumstance where everybody funds the government, everybody pays a certain percent of progressive or maybe regressive tax money. But in terms of federal taxes are generally pretty progressive. And you'll notice that I think that this graph above me is pretty interesting because it shows you that payroll taxes and income taxes are a large percentage share of the revenue that the federal government has. If we look at this from a different angle, if we look at the federal government's revenue, these are two different graphs that sort of show where the government's revenue comes from. So the reason we're talking about taxes and wealth taxes is because that wealth tax would add a chunk, maybe not that big a chunk, to this pie chart of more money for the government to spend more revenue on, which I think is the main reason why we are talking about the history of taxes to begin with. Now that I've talked about the history of taxes in general, I want to get specific about wealth taxes. If we look at the ancient history of wealth taxes, there's two big concepts that I'm not going to spend a lot of time on because I want to get into the modern times, but they are ancient Athens, which had a wealth registry. Again, didn't look into this that much, so not sure if it was voluntary or required, but there was definitely some concept of a tax for wealthy people. There is the concept in the Islam religion of the zakat, and that would be 2.5%, some type of a wealth tax. Again, going to jump into how we look at this in the modern history of the world. If we look at the wealth taxes in the not so modern times, in the antebellum, post-antebellum South, there were, or in just post-antebellum America in general, there was the idea of a general property tax, a property tax that not just included real estate, but included things like livestock, land, all sorts of things like that. In Michigan in 1893, there was a general property tax, which taxed all property and all intangibles at face value. So again, there's going to be different ways to interpret a wealth tax, different terminology, different lingo. I think face value, intangibles, things like that, while this history might not be important, that is an interesting way to think about how the wealth tax would work. If we jump into modern times, in 1990, 12 European countries had wealth taxes, whereas only 3 of these countries, Switzerland, Norway, and Spain, have wealth taxes today. The main reason for this is that the Europeans just found them imposing. They found the wealth taxes punitive. They found them counterproductive. They found that a lot of rich people were evading them, avoiding the taxes. They were going to other places. So France had a lot of millionaire and billionaires leave. And just like in a lot of these countries, they found that wealth taxes just didn't raise very much revenue and became riddled with lots of evasion and exemptions and all sorts of different things like that. But in terms of the countries that still have them, Norway, Spain, and Switzerland are going to be key examples that a lot of people go to. And I think a lot of people, at least on the negative, are going to lean on Norway because there is a lot of negative literature coming out of that country. Whereas I think Switzerland might be a place where a lot of affirmative teams lean on. But again, a lot of countries just abolished the wealth tax. France abolished the wealth tax. Germany abolished the wealth tax. There's all sorts of examples of this where even countries like Belgium, Italy, and the Netherlands switched to doing selected wealth, which I think might be a counterplan on this topic that it didn't include, rather than taxing all wealth, which I think is interesting. But there's also some more sort of reversing of the course in terms of, if we look at this chart, the number of countries who have had a wealth tax has definitely been going down in terms of economically developed countries. Now, that might actually be changing. I know I just talked about how a bunch of countries abolished the wealth tax, but it's kind of becoming a more popular concept in recent times. In Latin America, you saw Bolivia introduce a wealth tax, I believe in 2021, to help pay for the pandemic. It basically proves the idea that a wealth tax is used in modern times as an emergency tax. It's used to generate additional revenue after major shocks, and those major shocks are generally wars and recessions, which COVID would be an example of. Colombia would be another example of a country who has a wealth tax. I have read a lot of literature about the G20 trying to do a global minimum tax. Again, if you have stuck with me in the whole part, not skipped around, minimum tax might not be a wealth tax, but this is an interesting concept because it would answer how billionaires are hypermobile. So France had an issue with billionaires leaving their country and going to a different country. If all of the G20 did it, that would be much harder because there would be nowhere for these rich people to exit, which I think would be a really good answer to an exit tax, which I'm going to talk about more in a little bit. But there's just been a little bit more headway recently. I've seen a lot of literature in the last week or two about the UK potentially doing a wealth tax in order to fund heating people's homes over the winter. France, it's becoming a lot more popular in sort of their media, even though they had a wealth tax and abolished it. In America, I think we are seeing a lot of progressive candidates, people like Elizabeth Warren and Bernie, go for this wealth tax as well because it just kind of fits in how their progressive ideologies work. And on a lot of these wealth distribution, social issues topics, we end up getting a lot of progressive European ideas because that is where historically these type of ideologies come from. The other reason that it has become repopularized is that there is a French economist named Thomas Piketty, and he originally wrote a book, I believe in 2013, called The Capital in the 21st Century. This book was really popular, and its general premise was 2% of a global wealth tax so that you could solve inequality. He's released a couple different books since then, has different concepts about how you should fund a wealth tax, where that should go. But just note that, as the title for the last book says, a lot of these concepts are more socialist in nature, in that the government should provide for its citizens. So you are going to see a lot more sort of socialist literature advocating for the topic than maybe in past topics, whereas, a living wage that we just had seems a lot more capitalist than the idea of this topic. But the general idea is, why would all these people want to be going after these billionaires, centimillionaires, wealthy, whatever you want to call them? And the basic premise is just they have a lot of income that's not taxed. Again, if you've stuck with me this whole time, we've talked about how people like Jeff Bezos, Elon Musk, Mark Zuckerberg, they own a lot of stock that is unrealized, so they don't pay taxes on that. In 2007, Jeff Bezos paid no federal income tax, but Amazon's stock price doubled. The reason he paid no federal income taxes is he had no net income. He offset any income that he had by losses, deductions, debts, things like that. Michael Bloomberg, Carl Icahn both did the same thing, where they were able to pay zero federal taxes. In 2018, Elon Musk paid zero federal taxes. Again, the reason that they are able to do this is that their money is not realized and they have low income. So Jeff Bezos' salary is only $80,000. I want to say that in the tech field, that people who own the majority of privately held stock and things like Google, Oracle, Facebook, all paid themselves $1 to try to make their income lower in order to game the system this way, which was a way to game taxes that was popularized by Steve Jobs. And the ideology here was, if you have a low income, then the federal government can't tax you. This was taken a step further by Warren Buffett, who popularized the idea of not taking dividends. The idea behind this is that a stock generates different profits and dividends, and you can either pay those out or you can reinvest them in the company. Warren Buffett is famous with Berkshire Hathaway of always reinvesting that money so that he never had to pay taxes on that money. So the way that this whole system has worked is these billionaires, centimillionaires are able to generate a ton of wealth, but not pay any taxes on that wealth. Whereas, maybe an average American who receives a paycheck every cycle pays paycheck on or pays taxes on all of those earnings every time they get a paycheck, where the billionaires are not doing the same because they're not classified as earnings because they are unrealized. Well, okay, Scott, so the billionaires don't have money, they have stocks. How do they have all these private jets and fancy things and all of that type of stuff? The general idea, how are they spending this money, how are they buying fancy homes, is they're borrowing the money. So the general idea is that instead of selling their stock, they take out a loan from the bank, and they pay that bank rate back at single-digit interest rates. And that single-digit interest rate that has no tax, because the IRS does not consider loans a source of income because they are paid back, means that that interest rate is way lower than a tax rate. So they just work their finances out that way. Now, the way that this works is that the bank takes some collateral. They take some of that stock in as collateral, as sort of to hold you accountable in case they don't get their money back. The famous example of this is that billionaire Larry Ellison, who I believe owns like a whole island in Hawaii, has a bank loan of $10 billion against his stock where he can just hit up money anytime he wants. And that's how they're able to sort of game this whole system to get wealthy without paying as much or as many taxes or as big as a rate as modern day Americans. Now, why is taxing wealthy people popular? The simple answer is the majority of Americans are just not wealthy. We're talking about, if we look at centimillionaires, we're only talking about 10,000 Americans versus a number of American citizens that is in the hundreds of millions. If we take this and look at it, that would mean that, you know, a large majority of people aren't affected, so they're okay with pillaging rich people for a lot of their money. However, the second reason it's popular is these same Americans, you know, inherited wealth is different than self-made wealth. And they really don't like when you just are able to sit on money that's inherited and inherited and inherited. Now, the problem with this is that this is kind of a logical fallacy, because only 15% of wealth is inherited. A lot of it is not generated this way. However, for all of the wealthy people that do have wealth, I think that this would create a use it or lose it mentality where they can't just like sit on their big piles of cash like Scrooge McDuck and yell at people. They have to use that money and generate extra profits in order to take higher returns to pay for their wealth tax. It would hit people the hardest who aren't generating lots of wealth or income from their wealth. If we look at this, if they have a 8% yield on their wealth, they are better off because their income is less affected than it would be at 4%. Therefore, this behooves rich people, it behooves wealthy people who are affected by this tax to prioritize their money into doing things that are productive with their money. Now, before I end this history section, I always end the history section by talking about the history of debating topics. We've had a lot of similar topics to this. We have not had a topic in high school Lincoln Douglas or in policy debate that has used the word tax before. Now, last year's policy debate topic that was about fiscal redistribution, there's a lot of evidence that that included a tax. So there's a lot of tax affirmatives from that. But I think that this is the first time that tax has ever been debated in high school Lincoln Douglas or policy debate. I do think that there's a lot of crossover between different topics that we've had in the past, whether that be a basic income, a jobs guarantee, the past living wage topic we have. I also think that there's just different times where a wealth tax has been debated before. So I found a lot of advantage counterplans at the college level that had a wealth tax to fund the mechanism for the affirmative. There was definitely a wealth tax to fund a Green New Deal affirmative in the Michigan Camp Files from last year. Dartmouth definitely reads a version of a carbon wealth tax that may or not be a part of our topic. Might be a counterplan, not an affirmative. I'm not sure. But all of these things are places where you might be able to leverage some evidence to get further ahead on the topic. The one thing that I want to end here is that I was kind of bummed out when this topic came out because I thought it was just another topic that was the living wage again, and I was kind of bummed. And the more I look at this and the more I research it, that's just not the case. And I think that this topic is really, really a much better topic. And I also just think that a lot of the ways that the living wage topic debated the economy is very different from how this topic deals with the economy. So I would caution you towards viewing your arguments as just, oh, I can repackage all of the things from last month's topic, because that's definitely not the case. Speaking of arguments, now that we're over an hour into the video already, let's finally get to some arguments that you can say on this wealth tax topic. I'm going to start by talking about value criterion cases and philosophical cases that utilize moral philosophy. Let's start with the basics. So I'm going to start with utilitarianism. I think that this is a place a lot of people are going to go. The reason for this is that, as I've already discussed, the topic is a claim of policy and asks what the government should do, and normally when a government looks at what it should do, it weighs the benefits for the greatest number of people that it can have. I also think that you will have a lot of different teams on this topic read different value criterions that are about morality or about structural violence. I think that the nature of this topic in terms of reducing the wealth gap or decreasing wealth has a sort of go-to angle for any structural violence style value criterion that you want to read. I also think that there are going to be a number of value criterions that are based on the difference between a meritocracy, a plutocracy, and an oligarchy. The difference between these being if you earned the position or wealth or whatever your prestige be based on merit, or if you did that based on other things like who your parents were or the wealth that you had, which would be a case that would not be anti-meritocratic. I think that you would look at these different angles if you want to look more at a democracy angle in terms of the resolution. I think that the biggest value criterion that's not util that people will go to is best described as the difference between Rawls and the difference between Nov-Dec. If we look at egalitarianism and we look at libertarianism, I think that these different moral philosophies have very different viewpoints on the topic that are juxtaposed to each other. I'm going to start with Nov-Dec. If we look at Nov-Dec, Nov-Dec's idea is that people are entitled to their own goods. If somebody earned a good, they should be able to have that good because they justly acquired it, and the government should not take that holding or take that from them because they justly acquired it themselves, and it would not be morally permissible for somebody else to take something that you have already acquired. This is the basic concept behind libertarianism, where mandatory taxes are very limited to the state protecting and enforcing rights and doing nothing other than that, and basically being based on freedom rather than being based on equality. I think a good example of this is Ayn Rand and objectivism in Ayn Rand's works. The government only has three functions: the police, the military, and the courts. All of these things are to protect property and to protect the self, whether that be protect your property domestically or from foreign nations, and that everything else would be an aspect of tyranny because taxation itself is in itself a theft of the government taking money that has already been justly acquired, and the government is not morally justified in taking wealth that the person has already generated. The juxtaposition to this is Rawls, who is based in egalitarianism, that says that everything should be based on equality. The juxtaposition to Nov-Dec is that Nov-Dec thinks everything is about property rights and that the government should be severely constrained from being able to have rights over an individual's property, whereas Rawls thinks the opposite. There's no constraints on property rights, and it should be more based on equality. If we look at a Rawlsian theory of justice, I think that this is a really good value criterion on this topic, because a lot of people are going to use Rawls's veil of ignorance to say that in a society where you don't know who you are going to be, so the idea behind the veil of ignorance is that you don't know who you are going to be, you don't know your ethnicity, your race, your gender, your sexuality, your age, any of those things you don't know. So you looking underneath of that veil of ignorance are more likely to maximize and create a system that benefits everybody equally and primarily distributes social goods towards people who need those social goods. Another concept underneath of this Rawlsian umbrella that I think people will use is the difference principle, the idea that these societal assets should be arranged in terms of inequity. They should be arranged to benefit those who are the least advantaged because they have the most difference in society. I think that distributive justice is a good example of this, and probably all underneath this same umbrella is that society should make actions that compensate people who have the biggest misfortune, because we don't have the ability as human beings to predetermine our fortune, and a lot of that is based on birth and all sorts of different things that I've already discussed. And I think that this idea of distributive justice would say it should be the job of the government to make sure that that happens, because the current mechanisms, whether it be by birth, etc., do not fairly distribute the resources. So that if we looked at this distributively, that it should instead be have those resources that the government is able to take best equate for equality. I think that a great example of this would be luck egalitarianism, which would prioritize the mitigation of luck-based factors. So who you're born to based, or, that would be an example of it, based on how you live your life, your well-being. So this would say, things like race, gender, etc., those luck-based things that aren't able to be determined, we should prioritize all of those things first. Other circumstances would be social or other aspects. I think that the social contract theory is another example of a value criterion that's very similar, in that a lot of contract theory says that when you pay the taxes, you do that because it is agreement between the voter and the government. You don't have to pay taxes. You could go somewhere else where those taxes don't apply, but by being in the United States, by being a U.S. citizen, by being a U.S. taxpayer, you have entered into a contract with the government where you have exchanged your money for certain services or social goods, and that contract is something that is good and should be valued. I think that there's a lot of aspects to this that are outside the scope of this video, but I think that this would be a great place for a lot of teams to go in terms of the value criterion portion of the debate. I also think on the same level that you'll see a lot of people say communitarianism or individualism is bad. The idea is that people should be connected to their community. If wealthy people aren't having benefit for the least well off, they aren't providing the connections that the community needs. Maybe if we did a wealth tax, it would increase the bonds between different people in society. I think individualism would also be opposed to a Nozick way of looking at the world, where this type of social insurance that taxes provide through equality also would protect these private goods. I think that sort of lastly, in this part of the value criterion section, I think that a lot of people will talk about the ethic of care. I think that this will be very similar to communitarianism and social contract theory. I also think that you might see this in the critical literature, where people will talk about care work or a feminist ethic of care, things like that, that basically revolve around the idea that one should view the self and other people as being treated with equal worth, despite the fact that you might have a difference in power or a difference in money. Everything should be fair because we should all collectively care for one another as a social practice to strengthen our relationships with one another, embrace one another, and sort of have a feeling of belonging within our community. I think a lot of people might look to Bauman here or something like that. I want to sort of end by talking about Kant. I know that a lot of people like to read Kant in Lincoln Douglas debate right now, but I think that Rawls might be a better idea or a better way to do that on this topic, because I think that a lot of Kant's moral theory is more or less Rawls and Kant as Rawls and Rawls as Kant. And I think that the idea of justice as fairness that Rawls has is very much based on Kant. I think that if you would like to say Kant, I think that the basic premise of Kant, that each person should have their own basic right to equal freedom, is one that sounds a lot like Rawls, like we just talked about. But I think that there's some other aspects where you might be able to talk about the theory of public right, the categorical imperative. I think categorical imperative might be negative. I'm not sure. If you want to dive more into this, you are more than welcome to. But I think that the Rawls part of this value criterion section is going to be more where you're going to see Kant debaters go than just like a manual. So that being said, I want to finish this off by talking about virtue ethics. I think some people will say our action should not be based on a consequence. Our action should not be based on even the act itself, not the consequences of the act, and not the act, but the character of the actor, which is what virtue ethics is going to say. It's going to say that the actor must promote the biggest desired value. For virtue ethics, the two biggest sort of virtues that a government can have is autonomy, the freedom to make choices, and the equality of opportunity. I think that given the wealth tax, I think that this would be a phenomenal place for a lot of value criterion debaters to go. And I also think a lot of other autonomy-based value criterions will be utilized on this topic because the state is used to justify that autonomy, because people without the social services, programs that are funded through the wealth tax, people don't have autonomy. If the government's not there, there's no one who enforces the right to be autonomous. And I think that that is something to think about. Finally, I think that some people will talk about personhood. They'll talk about different agency action, different ways in which humans view their own agency, different autonomy views, similar to what I've already talked about, and just general rights-based frameworks, because the general idea is that we should do a wealth tax because there are people who are not well off right now. The wealth is taken from people because there are people who would be better served by the money that these wealthy people are just sitting on. And I think that you will see a lot of value criterions based off of this. I think that this topic is a phenomenal value criterion topic, and I think that people who want to make moral philosophy arguments will find a lot of different arguments, a lot of different styles, a lot of different literature bases to go to, because while this is a sort of resolution of policy or a fact of policy, I think that there's a lot of ground for moral philosophy arguments on this topic. I want to flip it over to the affirmative contentions, the meat and potatoes, the topic, the affirmative advantage areas. I want to point out before I get started that I'm going to talk about planned affirmatives in a second, but a lot of these different contention areas that I'm going to talk about and a lot of the different ideas and concepts that I'm going to mention could definitely be used in different planned affirmatives. So you would be wise to pay attention in this section, even if you're looking to not run like the generic contention 1 inequality. That being said, I think maybe you should read contention 1 inequality because I think it is the most core argument on this topic. While I have grouped it underneath this redistribution of wealth good heading, I think that there's a really good argument that it should just be its own contention because it is just kind of the crux of this topic. The idea is that the wealth tax would be used to address the growing wealth gap right now, that this wealth tax would promote economic equity because it would ensure that the richest Americans contribute a lot more money. We've already talked about how in some years, the richest Americans don't even pay income taxes with how this works, and that a normal person who makes $50,000 paid a higher percentage of taxes or just higher dollar amount in taxes than a lot of these billionaires. And I think that this wealth tax would level the playing field. I also think for aspects like poverty and different structural violence arguments, that the concept of the wealth tax is going to redistribute goods, fund social programs, reduce income inequality, and has a really good tie-in to poverty on this topic. I also think that racial equity, addressing the racial wealth gap, is a really good piece of affirmative contention area on this topic, because the action of the wealth tax would immediately reduce the racial wealth inequality by hundreds of billions of dollars, just by the simple mechanism of it would lop tons of money off of the top of this racial wealth gap. I think that another great example that's very similar to the racial wealth gap would be a sexism or a gender version of this. I think that there's a lot of literature that says that a wealth tax would primarily help gender marginalized individuals because they have not historically been able to accumulate wealth in a manner comparative to men. I think that the racial wealth scenario would look very similar to this. I think that there could be also different versions of this that talk about material wealth and other forms of wealth that aren't typically seen as like masculine forms of wealth that would be really good ground for the affirmative on this topic. I also think that moving on from this redistribution of wealth heading, I think that democracy is going to be a really good piece of affirmative ground on this topic, because wealth in and of itself is likely anti-democratic. If we look at the wealth tax, it probably prevents oligarchy because extreme wealth is not representative, because the people at the top are such a small percentage but have a really big outsized political willpower to be able to influence politics. I think this is especially true in the wake of Citizens v. United, and you're seeing this especially in this political cycle where Elon Musk's super PAC, America PAC, in the last 3 months has given $75 million to former President Trump's campaign. I think that the idea behind the wealth tax would be to prevent this oligarchic drift where rich people can control politics, because if we don't do that, it will continue to undermine our democracy and this social compact that we have together, and that the wealth tax would sort of build social trust and cohesion within society. I think that there is a similar but different contention for populism, where it would use the same wealth inequality link, if you say, and it would just say that this unchecked power that the elites have right now is what is making people mad and what's demanding people to be populist extremists. If a wealth tax lumped off a fair share of that, that might reduce xenophobia. It might reduce racism, because even though right-wing populism or populism has a very complex root cause dynamic, I think that one of the key drivers of it is economic insecurity. So if the affirmative is able to resolve economic insecurity, I think that the affirmative will be able to read a lot of really good populism contentions on the affirmative on this topic. I also think that a lot of people are going to say pandemic-related contentions. I'll talk about this a little bit when I get to revenue in a second, but I think that Latin America is a really good example of this, where the reason a wealth tax or a tax in general is implemented is at the extremes. When there is recession, when there's war. COVID classifies potentially as both of those things. And I think that there's really good literature that says that we would institute a wealth tax to both fund the massive expenditure that was COVID, but also to fund future disease prevention efforts. I also think that there's going to be a huge climate contention on this topic. I think that this is very, very simple in the sense that millionaires, centimillionaires, billionaires all emit tons of carbon. They all fly in private planes and do things that super wealthy people do, like have yachts, and these things destroy the biosphere, destroy biodiversity, and that would be bad. I think that there's a carbon wealth tax version of this that might work that I'll talk about in the planned section, but there's definitely teams that are going to read different climate arguments. I think that there is also a different angle of this where maybe the impact of the impact of wealth tax will change our social dynamics versus how we view extreme wealth. Maybe the wealth tax will undercut the media's envy, society's envy of extreme wealth. Maybe everybody will not want to be the next Jeff Bezos, the next Jay-Z, the next billionaire, because they don't want this form of extreme wealth because they know that that tax is going to come with it. I think while all of these contentions are good, I think that probably number 2 to inequality is just that the affirmative would generate revenue. And I think that this is a broad category that could encompass a lot of different affirmative contention areas on this topic. The main reason for a tax is to generate revenue from the government. Therefore, you are going to see a lot of affirmatives that use the revenue from the wealth tax to do things, whether it be education, healthcare, infrastructure, housing, cybersecurity, disease preventions, smart grids. I could probably do a whole slide on infrastructure. There's probably a good case that I should, but all of these things could be different contention areas that you could talk about, because when the government takes in that tax money, they're going to do something with it. I also think that there would probably be a version of a hegemony affirmative on this topic, because it would talk about how funding the military is good. It would lead to increased defense. Probably pretty smart idea. I think that the interesting thing about that affirmative or some of these other ideas is that would actually be normal means. So right now, when something is taxed, the idea is, would that taxed fund the things that are currently being funded, or would it fund something new? And I think the idea of it being normal means and funding existing programs is interesting, because that would potentially lead to an affirmative that would pay down the debt of the United States. The United States has a huge increased debt. I think that there could be an argument that says that maybe that excess money will go towards doing that. Maybe that'll be good for arguments like dollar hegemony and things like that. I also think that on the flip side of that, there's a ton of other ideas that maybe aren't normal means that you could do as well. There was a whole affirmative put out on the past high school topic that was a wealth tax to fund a Green New Deal. I'm sure there's going to be a wealth tax to fund a universal basic income, a federal jobs guarantee, you name it. There's going to be different programs that are going to be funded via the wealth tax. I want to look at something real quick. I was reading an article while preparing this, and I just found a grocery list full of these things where a wealth tax could fund childcare, green jobs, climate change, poverty, vaccines, all of these types of things. And I think that this is a good example of that people are just going to potentially read a lot of different contentions about using that money for good. Now, the problem with that is I think that a lot of affirmatives are going to have to think about how they are going to answer circumvention, or just basically rich people trying to figure out a way to not pay the tax. If you think about it, the wealth tax would have to come with some program of enforcement, avoidance protections. It would definitely have to increase the IRS for a multitude of reasons, because rich people would try to do a number of things in order to try to prevent their assets from being taxed or taken from them. I think that a secondary thing to this is that a lot of people might talk about bureaucratic bloat with the IRS, because the IRS will have to now value all of these things. So I think that a lot of affirmatives might build in solvency mechanisms to deal with all of these things, maybe increase transparency, information sharing, enforcement mechanisms, banning trusts, banning LLCs, banning tax scams, maybe, if you even look at more simplistic things, if you look at the Biden-Harris min tax, there's an illiquid clause that says that if you have tradable assets that are less than 20% liquid, they only look at your tradable assets, but you pay a higher capital gains tax. I think that a lot of affirmatives might think about building in some type of solvency mechanism like this. I think that the exit tax is also a good example of this. The idea of an exit tax is wealth will not flee the country if there's a big tax on that wealth fleeing the country. The idea behind this would be if a rich person is faced with the wealth tax, they'll just move to a different country that doesn't have a wealth tax. But an exit tax would say, you can do that, but we're taking 50% of everything right now. And I think that this would be an example of this type of anti-circumvention enforcement mechanism that a lot of affirmatives will try to build in to deal with these types of arguments that the negative is going to make. I also just think simply from a solvency perspective, there's a lot of different countries that could be looked at. I also think that there's a lot of different statistics from these countries that will be useful when you're trying to construct your affirmative contentions on this topic. The last place that I want to go on this is farms. I think that the wealth tax might protect agriculture. I think that it would likely hurt corporate agro businesses and corporate billionaires who are going in to farming. I think that the biggest example in the news of this is just billionaires going in and buying up a bunch of small farms. So Bill Gates, for example, owns the largest amount of farmland as a private citizen. There's all sorts of different other examples of this where I want to say Ted Turner is one of the biggest landowners, or was one of the biggest landowners in America. Stan Kroenke, who owns the Rams, the Nuggets, and Arsenal, lots of other sports teams, owns a bunch of farms. But I think maybe a better example for this topic is that a farming company is literally America's largest private company. The Cargill family is the fourth richest family in America, only behind the Waltons, the Kochs, and the Mars, and their fortune is all in farming. And Cargill America is the largest private company in America. It has 21 different billionaires that account for that farming company being their main source of their wealth. I think that there are a lot of really good examples of this. However, I also think on the negative side, we may see a negative contention that says that the wealth tax is bad for small farms, because if we look at the history of small farms, the number one thing that takes them out of business is the estate tax, because small farmers have no liquidity. Their liquidity is their farm. So if they are faced with a wealth tax, the only thing that they can do is sell off the farm, which is bad. I think that the caveat to this, and I just talked about circumvention, so let's talk about it again, is there have been exemptions in the past from wealth tax on farms and farmland. They look at farmland different than land in how taxes work on the wealth tax potentially. So I think that maybe an exemption mechanism might be a way out of that, but I think that the farming contention might be an interesting aspect to look at. I think that there's a charity or philanthropy contention. I will just kind of leave it at that. If you're more interested in that, I'm going to link in the bio, whatever you call it, below, the Kanki brief. It is a free brief, and there is a huge contention that goes through how rich people donate to charities in order to get rid of their tax burden, and how the wealth tax would come after these charitable foundations, and maybe that this form of gift giving and charity and philanthropy is not the best idea. I think that the last thing that I want to talk about, besides economic growth, which I think isn't great on this topic, so I'll just kind of leave it at that. I don't think that the affirmative is a great place for the economy, but I think that a lot of affirmatives might talk about degrowth as a way to access capitalism on this topic, but I'm going to leave that for the capitalism portion, which I'll talk about when I get to critiques. What I do want to talk about lastly is agency defense. I think that on a topic like this, on domestic topics, a lot of people are prone to read things like process counterplans, and I think that you will see a lot of teams try to read agent or actor-based contentions. Congress seems like a really great place to go for your contention or your advantage, because The Article 1 powers in the Constitution grant Congress the ability to tax. So I think that a lot of teams might think about making a congressional powers argument just simply for the fact that normally strategic affirmatives try to have an advantage about the topic substance, an advantage about the actor, an advantage about the process in order to beat back a lot of strategic negative arguments. And I think that a Congress powers contention would do two of those things. So hopefully this was helpful. And now I want to flip it over to the planned affirmatives. Affirmative plans, I'm going to try to keep this short, unlike the rest of this video. I think that the first type of affirmative plan that you are going to see is a wealth tax to fund something. I talked about this in the affirmative contention areas a lot, but I think a lot of people will say that a tax's main purpose is to generate revenue for things, whether that be a Green New Deal, universal basic income, health care, the military, disease, you name it. I think that people will read specific versions of the affirmative that try to use that revenue in a specific way. I also think that people will read different versions of a wealth tax in terms of what the rate or what the plan is. Earlier in the video, I had all of the different wealth plans in the United States up, whether it was Bernie's or Elizabeth Warren's or different states or different countries. And I think the more that you research this, everybody has a different idea of what the wealth tax is. And it might be smart for a lot of affirmative teams that read plans to specify what exactly they do and what exactly their rates and plans are, because it will help them strategically beat a lot of negative arguments, especially with the economy, on this topic. I also think that there will be a similar type of affirmative to that changes what the threshold is. Remember, those same plans, some started at 20 million, 32 million, 250 million. I think that you will see affirmatives that only apply to billionaires, only apply to centimillionaires, like the Biden-Harris plan, only apply to people who have 10 figures. And I think that the basic premise for this would be that they wouldn't link to a small business's DSAD. So your person who is worth $10 million, who's taxed under some radical plan, would not be taxed under this, and that would be beneficial to you because the number one threat to you, which we'll get to in a second, is probably going to be the economy DSAD. I also think that there will be affirmatives that use time in its nature to read a plan. So I think we will definitely have people read the one-off wealth tax, where the wealth tax is not annual and just happens once. I personally, based on what I've read, I don't think this is topical, which I'll get to in the T section, but there's great examples of this happening. I think that there's better examples of non-permanent wealth taxes where they lasted for a period of time and then sunsetted after a certain period of time. I definitely think people will try to read affirmatives like that. I think people might even try to get tricky and expand current taxes like the estate tax, the inheritance tax, gift tax, things like that, and say that those are taxes on wealth. And that might be a tricky way to avoid a lot of the core literature on the topic by reading a planned affirmative, by taking advantage of your tax knowledge. I think that there will also be, just like the tax to fund different things, I think that there will be affirmatives that try to tax different assets. If you think that a wealth tax is not all assets and you think it's some assets, which there are definitions for, I'm just not sure that that's a great way of viewing the topic. But if you do view the topic that way, you could do a wealth tax on specific things. You could do it on specific things that billionaires use, like private planes or yachts or mega mansions, or sports teams would be a great example of this. I also think that you will definitively have different versions of a carbon wealth tax or a carbon-based wealth tax. There's really good literature for this in terms of taxing carbon assets that are based in brown capital rather than in green capital. I'm not sure this is topical. I think it might be a carbon tax and not a wealth tax. That kind of seems like a consumption tax to me, but I think that you could definitely use a wealth tax to deal with carbon things, and I think that a lot of people are going to be drawn to this, one, because the literature's there, but two, is that Dartmouth in college reads a very similar version to this that I think teams might be drawn to. I also think that teams are going to have different anti-circumvention mechanisms, different exemptions, as a way to do the affirmative, whether it be to do the wealth tax, but not for small businesses, not in specific places, not in specific tech sectors, not for green jobs. There's all sorts of literature because, again, tax law is uneven, taxes are complex. There's lots of different exemptions that people make where I think that you might see these actually built into the plan text. About 10 years ago, there were a couple teams, I want to say it was Greenhill and Policy Debate, that was really good at reading exemption-based plan texts, and the reason for this wouldn't necessarily be like extra tea to like read advantages to that, but just to get out of some of the negatives core ground on this topic. I also think that you will see different affirmatives try to say that regulation measures happen as a way with the affirmative, so we will try to do a wealth tax where you value everything by some independent database that does things a certain way, evasion mechanisms, bank account sharing. I don't even know what it could be, but I think that you will see people try to do this underneath the affirmative to try to counteract a lot of these solvency takeouts or circumvention arguments that the negative is going to make. I also think you might see people just define United States as the states. I keep saying this in all of these videos and nobody ever does it, but there's actually literature for this on this topic where California, Connecticut, Hawaii, New York, Maryland, Illinois, Washington, etc. have all been collaborating together. The problem with this is that maybe the capital flight thing that we're about to talk about when we talk about disads is actually real for this, because it's just kind of happening. If we look at California right now, California has really high taxes, lots of billionaires leaving California to go other places that have a lot of low taxes. I think that while this isn't comprehensive at all, I think this is a good sample of what people may read in terms of different affirmative plans on this topic. I want to go back for a second before I finish the affirmative section and just touch on growth a second, because I don't think I gave that enough love, and I think that a lot of affirmatives might read growth-based arguments to try to just counteract how much the negative is going to say economy arguments. I think that growth might be something to consider, because if you think about it, if the assets are going to be taxed by a wealth tax, it incentivizes those people who are affected by the wealth tax to invest in their businesses, invest in expanding, invest in productive investments, rather than hoarding all of their money because they need yields in order to pay that wealth tax. The wealth tax would encourage investments, it would generate benefits, tangible benefits, and that wealth tax could lead to the economy just being better as a whole, and would lead to a healthier economic environment that would be more driven by productivity, which would foster job creation, stimulate the economy, all sorts of things like that. I also think that some of the affirmatives that I talked about, like the infrastructure affirmative, will probably say growth as well, because a lot of these programs that a wealth tax would finance, like infrastructure, science research, education, building roads, colleges, financing green energy, whatever it may be, all have an economic input that can be used. I think that this might be a place where people go, but it wouldn't shock me if people go the opposite direction and say that the affirmative reduces GDP and that we need to go in the opposite direction of growth. I think that's more of like the cap K, which I'm going to get to under critiques, but I definitely think that people will read the degrowth affirmative on this topic. So now that we've finished talking about the affirmative side of the ball, at least until we talk about critical affirmatives in a little bit here, I want to flip it over and talk about the negative. I want to start this section by saying that I grouped negative contentions and disadvantages together, so you're just going to have to use some thought power to do that. The first argument that I want to talk about for the negative is capital flight. I think this is the core argument on this topic that just says wealthy individuals will leave, they'll relocate to countries that have more favorable tax environments. I think that this would be bad because it would reduce investment in the United States. It would harm jobs because these wealthy people who create jobs through their companies would go elsewhere to other countries that have a better tax environment, maybe like UAE, which I don't think has income taxes. This would cause the proverbial brain drain where these really smart people who are the source of our economy would go elsewhere, and it would lead to an ultimate loss of the tax revenue that is generated from those people. I think that there's a lot of good literature from France that talks about this. There's also a lot of good literature about California, how people will just move if they are subject to the wealth tax because they are more concerned with their wealth than where they live. I think that this is also true in an era where there's different countries where you can get golden visas, where if you invest a certain amount, you can just get citizenship immediately. And this would be really, really, really interesting to billionaires who are about to get taxed. I think that one of the ways to counteract this is an exit tax, the idea that a wealth tax would come with a tax that would be additional if you left the country. I am not sure how this would work, but I think that a lot of teams are going to try to do this on the affirmative just because I think the capital flight negative contention is really core of the topic and just a really good argument. I also think that teams are going to say just bureaucracy bad. They're likely to say it through some version of an IRS disadvantage. I think that they're just going to say that there's really high administrative costs. You're going to have all of these complex issues that come with the implementation, whether it be different bureaucracy things or just like it's hard to value. You'd have to have a team of people working for each billionaire in order to value all of their different assets, and these types of high administrative costs are the reasons that countries like Austria repealed their wealth tax to begin with. I think that next, while this isn't necessarily a contention, more a solvency takeout, I think that evasion or avoidance is a huge place where the negative is going to get ground, because a lot of the affirmative statistics all assume the best case scenario where everything is taxed and doesn't assume billionaires and centimillionaires who are able to find loopholes in the law, offshore their money, come to complex financial agreements, whether, that be putting your money under different asset companies, having complex share structures where you spread the ownership all over, where you have multiple share classes, different investors, you have debt, you spread it out amongst LLCs. There are all sorts of different ways that might even feed into this IRS argument that we just talked about, that it's just like billionaires will complicate this because they will try to undermine the taxes purpose by just restructuring their assets in a way that makes it really, really, really hard for that to be valued or to go after. If we look at this, maybe it'll make people take their businesses private because there's no clear market value from their shares. Maybe they'll change how real estate is valued. It's really complex. Everything is valued different. Maybe they'll invest in fine art and jewelry and collectibles that are really hard to value. I think that a lot of these things would make it so that the super wealthy would essentially hire a team of like wealth defense industry attorneys that would manage all of their money, trying to be able to make it as tax-free as possible. I think a good example of this is Peter Thiel, who put a lot of the PayPal sale money that he had into an IRA that in 3 years, I believe he is about to cash out of tax-free. I think that the wealth tax would encourage you to do things like this, to try to hide your billions of dollars in offshore bank accounts, shell companies, dynasty trusts, all sorts of different aspects like this. I also think that this defense industry of the wealth would try to have different exemptions for different billionaires. I already talked about this with farming, but I think that all of this is trying to prevent different circumvention arguments from being said in the debate. I also think that there is just a very simple consumption disad that billionaires, rather than saving their wealth and building their wealth to have a better place on Forbes 400 or whatever they're into, that they'll just consume it. They'll take their private jet around the world. They won't care about their business, and they will just spend. I think there's a really good version of this that they will just give their money away to political candidates and give it away to super PACs before it can get taxed, and they'll do all of this distortionary political spending on their own behalf, and that might even be net worse because they will use that for anti-democratic means or all sorts of different things to change how those consumption patterns work. Next, the economy disad. I want to start by saying I think that this could probably just be its own lecture because this might be the best link to an economy disad that I have seen in 20 years of doing debate. I think that there's a lot of different ways that you can read it, and I think that looking into these is really useful in being able to understand how the wealth tax work. First, if we look at wages, I think there's a good argument that says that when taxes on a business increase, that historically that has an inverse impact on wages. Pretty simply put, the wealthy have a lot less money to spend on employee wages or new investments in equipment or technology, benefits, health insurance, whatever it may be, because those businesses that are owned by their wealthy owners are forced to send that money to the IRS and can spend less money on all of the things that I've just mentioned, including hiring, expanding their workforce, their business, all of that type. I also think that there might be good ground for an inflation link on this topic, that if Jeff Bezos gets taxed, he'll just charge everybody 10 more bucks for Amazon Prime. He'll just pass it on to the consumers. I'm not sure how exactly this would work because the wealthy people aren't exactly the business. They would have to get approved by the investors in order to do that, and I don't think that that would work the way that they would think it would work, but I think that this is a good way of thinking about how the topic would interact with the economy. I think there's also a capital link, kind of just how I mentioned for wages. I think that it would just disincentivize capital investment, which in turn would be really bad for economic growth. I think a specific version of this would be that it would discourage investments in venture capital. The risks of being a startup company would be exponentially magnified because all of that wealth would be appreciated, but you would have no income flow in order to pay that. So you would subject all of your venture wealth fund people to taxes without having the liquidity to pay those taxes. That in turn would tank the value of all your evaluation that was generated by the wealth tax to start with and would maybe hurt the company. It would probably discourage types of angel investment because they would just be afraid of all of these really high valuation costs. I also think that there would just be a consumption mindset versus a saving mindset for lots of billionaires where they don't see it being worth putting a lot of savings into things like machines and factories and economic capital because eventually they're not going to own any of that because the wealth tax is going to take it away. I think that the problem with all of these economy arguments that I am describing is that most affirmatives are going to say that income inequality is reduced by having money from the tax. But if we reduce the economy, we reduce the amount of money that is taxed, which means we have a reduced amount of money to combat inequality and things of that nature. So I think that this is an interesting interaction with the affirmative. I also think that while there might be a standalone innovation disad as well, I think that there's also just an innovation economy link. If you think about this, billionaires create value and they need to be rewarded. They won't do new projects. So for instance, if Elon Musk does Tesla and he's taxed a bunch, maybe he does not do SpaceX in the future because he doesn't want to have to deal with paying even more wealth tax. That wealth tax would discourage risk-taking among entrepreneurs. And eventually, it might even lead to people not wanting to be entrepreneurs in the future because the wealth tax is going to hit them anyway, so they might as well be a lawyer or a tax lawyer at that rather than an entrepreneur, because as an entrepreneur, they're just going to get super taxed and it's not worth it. So I think that it would also just discourage the industry as a whole, because it just wouldn't be worth it. The reason people try to be entrepreneurs is to make a bunch of money. Why would they risk their savings, get out and hustle, do whatever they need to do, grind on the pavement to take their product to market, to do whatever they do, make their billions, and then the government just come and take all that money back because of the wealth tax? So I think that people just wouldn't want to be entrepreneurs in the first place. We wouldn't see new innovations, we wouldn't see new inventions, because they would never happen in the first place, because those entrepreneurs wouldn't want them to come to fruition, because they're busy in other careers, because they don't want to have to deal with the wealth tax. I think that there might be other versions of this where maybe their time is traded off. So maybe these entrepreneurs or rich people, rather than building their businesses, have to spend time defending their fortune instead of doing innovative things or doing businesses. I think maybe a different version of this entrepreneurship DA would just be the entrepreneurs leave the United States before their fortune is made. So they would leave before they make it. And I think that a lot of these innovation disads are really, really good in terms of competitiveness, because if they leave the United States, then, that in the long run would hurt the U.S. economy, U.S. hegemony, tech leadership, all sorts of different aspects like that. I do think that there might be sort of a flip side to this for entrepreneurs. Maybe that because a wealth tax would force only the most productive entrepreneurs to make it, that would foster more innovation, like only the most productive billionaires would do it. But I think that the problem with this is that most innovation happens like the first go round. So I'm not really sure how this would work. I think that one of the better arguments for the economy on this topic, I know that all that just sounded great, but I think that the stock market is just slam dunk on this topic. And when I talk about liquidation, I think that a lot of affirmatives are just going to think about, how do we deal with this? Because this is a core way that you have to think about, or just a core way that you have to build your affirmative around, because if you can't answer these arguments, you can't win debates. The basic premise is billionaires own trillions of dollars of stock. It represents a lot of the stock market, and they would need to sell hundreds of billions of dollars worth of that stock. If they did that, the sale of those stocks would drive the stock prices down for everybody. Tech companies would be the hardest hit because their unrealized capital gains are the most concentrated. You also have to think about that this massive stock sale off, if your wealth taxes annually, would happen each and every year. It would drag down all of the investors, and it would end up reducing the amount of skin in the game that these innovative founders have who built the company, which in turn hurts all of the companies in the long run. I also think that the shrinkage of these stock markets, these stocks, these public markets, is really bad, because anybody who has a 401k, any different type of investment that's not affected by the wealth tax, has their investments impacted too, because when they sell those stocks, the stock's going to plummet. I think that this is even more problematic, and I don't even know how this would work for private companies, because these private companies would have to sell parts of the investment to cover the tax bill. And that's more difficult because they just can't go to a public market like the stock market and sell them. There would be difficulty in finding buyers. They would have the cost of selling high or low. These sales could disrupt how these companies are growing. If you think about it, there's more private companies with more value than ever in the United States, and this would be incredibly impacted. I think that, there are some circumvention measures that the affirmative could use. Like, I read something that you could put your stocks with the government and the government would give you money, but eventually if you couldn't pay your bill, the government would just sell your stocks off anyway. So I think that there's a big problem with all of this. I also think that there's a competitiveness scenario here where U.S. investors are just disadvantaged versus other investors, because investors in other countries don't have to pay the wealth taxes that US investors have to pay. I also think there's a separate scenario that's just kind of like an entrepreneurship version that says that, the next Tesla in the US might not make it versus the next Chinese version of Tesla, because the owners are going to be faced with a wealth tax, which means they can't be as efficient, as productive as other foreign ownership groups. I also think that this might encourage foreign ownership of US assets, where it would just encourage people who wouldn't be subject to a US wealth tax to invest in those things. I also think that maybe this would increase foreign markets. Maybe people would look to take their money overseas. I think that there is a really good small business disadvantage here. Kind of what I talked about with private companies. All these small businesses are privately held now. If they're faced with huge bills, how does that happen? There's probably a giant business confidence disadvantage that says that these companies that have owners that are worth $50+ million would just plummet. I think that there's also a really good argument, maybe this isn't a disad, maybe it's just like a link magnifier, that once the tax is instituted, much like any other income tax or any type of tax that the United States has, it increased eventually. The threshold will be lowered, where eventually it will eat up more and more and more of the economy. I want to stop off for a second, because I talked about the stock market, to talk about liquidation for a second and just give you some scenarios for how this would work. If we look at liquidation is the idea that someone has a private company, they have stock, they have unrealized gains, unrealized capital gains, that the wealth tax would force them to sell their shares, and that they would have to liquidate them. Now, that would maybe hurt businesses, it would hurt the markets, it would maybe create valuation problems, but I think that the bigger problem for this is just to think about how much it would impact not only the billionaires' wealth, but the things that those billionaires do. So earlier I talked about a hypothetical California founder who lost all of their money from the wealth tax. But I think if we think about this in a real world scenario, if we look at Jeff Bezos, for example, if he is forced with a wealth tax bill that's a bigger percentage, let's say, $10 billion, that redistributing of Bezos's wealth requires him to disrupt Amazon's operations, because he doesn't have that $10 billion sitting in a bank account. He has a stock. He has Amazon. And that Amazon is not just like money. It's a global operation that employs hundreds of thousands of people. And without that wealth, they don't have jobs or the ability to do their jobs. If he has to liquidate or sell his shares to pay for that tax bill, it's harder for Amazon to raise capital, create jobs, all sorts of different things that would affect its operations, and might even lead to a decrease in your ability to get Amazon, because he has had to sell a bunch of his shares. I think that almost all of the wealth that this bill targets, all of this unrealized gains, a lot of it would just be tied up in businesses that, sure, that's money, but those businesses produce goods and services, provide jobs, drive innovation. And these wealthy people, they're not Scrooge McDuck. They don't sit on the pot of gold, the stack of gold in their vault. They use that capital to have businesses, to have technological advancement, medical breakthroughs, innovative things that impact the economy and just all of us in general. I think that maybe a way to finish this would be, who would they sell these to? Would Jeff Bezos sell portions of Amazon to private company or to private individuals? Would people just be frothing to buy Amazon stock, or would BlackRock buy it up? I think that maybe this would lead to a shift in corporate ownership to try to get around the tax, because it's on the wealth of individuals, not on companies potentially, although that would be an interesting affirmative. I think that that would be maybe more net bad for the economy. I think that the final way of concluding this is I just found this meme that I found pretty funny, that I just think that a lot of the things that I've just talked about really, really make me think that the general premise of the wealth tax is probably not that good for the economy, and a lot of affirmatives will probably have to think about this because it's going to be the core ground for the negative on this topic. If we go past the economy, I think that there might be some specific versions of the economy disadvantaged. So where do billionaires spend their excesses? On space travel fantasies. So there's a lot of evidence that says that the wealth tax crushes private space enterprises. There's a lot of evidence from policy from last summer. There's a whole file on this. I think there could be a similar scenario for green tech. I think that a lot of private entrepreneurs are investing in tech that would lessen greenhouse gas emissions, things like Tesla, solar, batteries, but also future things like maybe carbon capture, other technologies. There's lots of billionaires that are all trying to get in the market for that, and a wealth tax would definitely undermine that. I think that all of these could be different examples of an innovation disad, where the more money they have to pay the government, the less money there is to invest in innovating in future tech, future climate things that can change the world. I think there's also probably a competitiveness version of this where US space is destroyed, US tech leadership is destroyed, rather than just SpaceX. So I think that there's lots of different avenues that you can take this. I also think that there is a group of disads that I don't know exactly what they are going to be, but I'm going to call them things billionaires spend money on. I think that things like yachts, mega mansions, real estate, all of those things would be impacted. I talked earlier about how a lot of billionaires like Bill Gates own massive amounts of farmland and land. If they were faced with a wealth tax bill, maybe they would sell that instead of their stock. That would cause the land prices to go down, and there's a lot of literature that talks about that. I also think that you could see people, because it's a domestic topic, they're going to go back to the federalism disad. I think that the link would be similar to the constitutionality link, which I'll talk about in a second. But I think that wealth taxes just might be state ground. I think that the appropriation part of Section 8 of Article 1 of the Constitution would make this potentially federally illegal because it would require equity, and because wealth is unevenly distributed across the states, like New York probably has more millionaires than North Dakota, I think that this would potentially fall under the state's jurisdiction. Potentially talk about some constitutional problems with this as well, where the federal government has an apportionment clause where it can only do direct taxes, and they have to be proportional to the population. They can't necessarily target individuals. I think this is up for debate. There was a court case, Moore versus US, that kind of left this up to interpretation, but I think a lot of the judges kind of signaled that they thought that this might have constitutional issues. I think one of the other things to think about that I haven't even talked about yet is that this money is just double taxed, right? When a billionaire has to liquidate shares to pay for this, they have to pay for the share, they have to pay a capital gains tax on those shares, and then they have to use that money that they gained to then get double taxed on the wealth tax. People earned it, they pay taxes on it, they invest it, then they pay taxes on it again. I think that this might be an interesting argument to take. I think that the politics disad is also going to be interesting. I know that a lot of people haven't been reading this recently, and a lot of people might just kind of be done with it after the election season. But again, I don't think there's going to be an elections disad. I think that we will likely know who the winner of the election is going to be going into the first topic or the first tournament on this topic, or at least I hope we do. And I think that we are going to see more agenda style arguments. I think that two things to think about. First is that from a public perspective, I think that the public would overwhelmingly support this just because a majority of them would not be affected. But billionaires and their lobbying efforts would be unbelievable. And this is proven in 2017 when Republicans did a giant tax cut that disproportionately affected or helped wealthy people. So I think that the links will go in different directions, but I definitely think that there are different versions of the economy disad. I think that while this might be more contention ground rather than disad ground, I also think that there's like a personal freedom, individual liberty, maybe like a libertarianism argument here that's just like the wealth tax is direct asset collection. That's bad. Free nations have no business helping themselves arbitrarily to the belongings of any group of citizens, let alone picking a particular group, and that ultimately impacts personal sovereignty, is coercive of the government, all sorts of different aspects like that. I think that the thing that I want to close off with disadvantages, not really disadvantage, but I didn't really have any other place to put it, is I think a lot of people will use historical examples to make solvency takeouts and to amplify all of these disadvantages. Their historical examples seem to go in the direction of the negative. Since 1990, tons of countries have repealed their wealth tax. France is a great example of this. I've seen so many different graphics that criticize how Norway did the wealth tax. And if you really think about this, a lot of the affirmatives are going to talk about grandiose things that they solve for. But if we look at the wealth tax, it's really not as much money as you think compared to the amount of money that the federal government spends. And I think Europe is a good example of this, where it only raised the GDP of Europe by like 0.2%. So I think that all of this is interesting to think about when you're trying to decide what disadvantages, which contentions to read on the wealth tax topic. Next, I want to jump to talking about counterplans. I think the first group of counterplans that will be popular on this topic are other tax mechanisms. I think the reason for this is that any affirmative that says do a tax to generate revenue to fund something, that these counterplans are just going to say do a different tax to fund that same thing, but a wealth tax is bad. I think that there's a bunch of different versions of this, a bunch of different types, and there's a lot of different back files that make these counterplans real low-hanging fruit, and there's just a lot of them. I think if you wanted to do new research, there might be some new taxes that would be interesting. So there's literature on an expenditures tax, where if you bought a yacht, there would be an incredible tax on that. I think that that might be a way of countering wealth in a way that is really strategic, but wouldn't link to certain disadvantages like a liquidation disad, a valuation disad, or land prices. I think another funding mechanism for this that would be similar would be to legalize marijuana. If you legalized marijuana and did a giant tax on it, that tax could be spent doing all of the things that the affirmative was going to do. I think that for affirmatives that say redistribution of wealth is good, I think that you'll see a category of affirmatives that just test that mechanism. I think the UBI counterplan, I think people even read the living wage affirmative as a counterplan on this topic because it might resolve a lot of the harms that affirmative teams talk about in their affirmative contentions. I think that the state's counterplan is going to be a really, really good argument. I talked about this under the affirmative section, but there is definitively uniform collaboration between different states right now in terms of trying to do a wealth tax. So California, Connecticut, Hawaii, New York, Maryland, Illinois, Washington, other states are all collaborating together to try to do this. Now, the problem is I'm not sure all the states would collaborate together unless you force them to, and affirmative would have, or the counterplan would have to, because the capital flight state disad would be really, really, really good. I do think, however, that there are good examples of instances of states implementing a wealth tax that have been tried but I don't think there's one that's actually happened. I think that along with these other tax counterplans, that you might see some version of the offsets counterplan that says you should just do a different funding mechanism for the affirmative, take the money from somewhere else. I think that the problem with this is that there's no increase language that this counterplan normally uses for competition. But I think if you picked out of the tax part, maybe the adoption part, I think that might be a place where you will see people gravitate to reading those types of counterplans. I also think that there's going to be a lot of specific counterplans on this topic in terms of what you think a wealth tax is, and I think this might behoove people to either get really specific in their affirmative or just try to be really nebulous. Although I think they're going to be specific because specificity is going to be the only way to beat a lot of the economy arguments that I just talked about. I think that there is definitely going to be an affirmative that does a one-time wealth tax. I think that there's definitely going to be an affirmative that does a one-time wealth tax, but there's definitely going to be a counterplan that does this. The way that this is going to work is it's going to change wealth tax to capital levy and say that there's a difference between the two. I'm going to get to this when I talk about topicality, but I think that there will be different temporal versions of the wealth tax that add sunset provisions, all sorts of things like that, that if the affirmative doesn't utilize, the negative is definitely going to take as ground for different counterplans. I think that the same thing is true with the definition of the wealth tax. We talked about how Bernie's plan is different than Warren's plan. I think that if somebody uses a specific wealth tax plan, somebody else might read another wealth tax version as a counterplan and then have a really minute debate about what the difference is, where they're able to generate a disadvantage to the affirmative but not to the negative. I also think people are going to do this with the thresholds, where they're going to say if you do a wealth tax, generally they are going to do more than that. So for instance, if the affirmative says wealth tax and that applies to everybody making over 50 million, maybe a counterplan to only do billionaires or to only do people who are worth 10 figures or only certain industries or certain people would really be more effective, because it would still generate a lot of that wealth, but maybe it does not impact small businesses or small private businesses the way that it would impact these other billionaires who might just be able to effectively shoulder the costs a little more. The last thing that I want to talk about in the counterplan section is that this is a domestic topic, which means every agency, process, debate that you have ever had is likely going to happen, because if the affirmative adopts a tax, it's probably the Congress. There's tons of different agency debates, whether it be the executive order, the signing statement, the courts, you name it. I think that the ground is there for pretty much anything the negative wants to say in terms of those process agency arguments that people make on all these domestic topics. So that's what I've got in terms of counterplans on the topic. Now what I want to do is I want to shift to talking about topicality. If we look at topicality on this topic, the first thing that we are going to look at is bare plurals. I think that this is potentially a better argument than on past topics, and I think that this might not get deployed as a bare plurals argument, but more a definition of the wealth tax. I have seen definitions that say that a wealth tax is some assets, but I think that wealth tax means all assets is going to be more where this is going to go. I think that the problem with bare plurals for topicality is that it is really hard because there's lots of different ideations about what that means, and it's not like a living wage where we can just generally say wages go up to a living level. A lot of these wealth taxes are talking about very specific things, and I also think that Yeah, I just think it's going to be read as T wealth tax instead. I think that you might see people read topicality arguments about Congress. I also think that you will see people say that wealth tax that the affirmative does is not a wealth tax. A lot of the literature, like the Biden Harris minimum income tax, is a tax on wealth, but it's not necessarily a wealth tax. So I think that this might be ground to read topicality arguments that define wealth tax and not just a tax on wealth. I think that there is an important distinction there, and that might open the floodgates to too many different affirmatives that are not a wealth tax, but rather an income tax and other aspects that aren't under the topic. I think that, again, the United States probably means the federal government. I haven't seen very many people read the states affirmative that I've been talking about, but I think you will have more people try to read this United States argument with the word adopt to say that Congress has to do it, maybe to get competition for an agency counterplan, something of that nature. I think something interesting to think about for topicality on this topic is, can the affirmative say where the tax money goes? Can they only do a wealth tax, or can they say what that money is spent on? And I think that whole extra T affects T debate is going to be a source where a lot of teams are going to try to generate some topicality arguments on this topic. The thing that I want to close out with on topicality is I've been talking about temporal arguments throughout this lecture in terms of, is a wealth tax a one-time thing? Is it limited? Is it permanent? Does it sunset? Does it have to be recurrent? And I found a pretty good definition that said that wealth tax had to be recurrent and annual. I think that maybe that would open it up to some sunsets affirmatives, some limited affirmatives. But I think that these one-time wealth tax affirmatives might not be topical, because I think that they might be a levy and not a tax. I think that defining the word wealth tax is going to be really important on this topic, because if you can get a robust definition of wealth tax, it is going to behoove you, because you might be able to include different things underneath the wealth tax. So for instance, in the Warren plan, there's a bunch of anti-evasion measures. If you think that those are a part of the wealth tax, that'd be great for the affirmative. If I was negative, I would probably say you can only do the tax. All of that stuff is extra topical. I think that that is an interesting way to think about the core issues of the topic and how you might think about preventing some of these circumvention arguments that are for sure coming on the topic. Now that I've talked about topicality, counterplans, disadvantages, I want to flip it over and take a more critical perspective on the topic. The first critical argument that I would like to talk about is the capitalism critique. I think that capitalism will be read both as a critical affirmative and as a critique on this topic, but I want to start by looking at the negative version of this. I think that there's going to be a lot of different links, a lot of different versions of this that I could never cover during the course of this long video, but I think that there's a couple versions that are worth noting. I think that the idea would be is that the wealth tax would end neoliberalism, but it would shift that power not necessarily to socialism, but back to the capitalist state, that the law of taxes is a way to preserve the social system the way that it is right now. The capitalist state just recalibrates itself to work differently, and it still legitimizes this same capitalist state. We look at this when, I think people will read some redistribution links potentially that say that that act of redistribution reifies the way in which the capitalist state works and allows it to continue to exist rather than radically changing or altering the capitalist system. I think that there are a lot of different links that people will go for here, but I think that this is a good example of the style of links that people will read. I think that people will read all different types of alternatives, but rather than talk about the alternatives, I want to talk about a different version of this capitalism argument, which I'm going to call the capitalism disad. This would just basically be an unsustainability version of this capitalism argument that would say capitalism's collapsing now, it's unsustainable, but the way in which the affirmative does a wealth tax makes capitalism work, and that is bad. I think that the way in which the wealth tax would sort of recalibrate economics would be a link here, and there is definitely literature that I have seen talking about how a universal basic income sort of serves this same purpose because it gives every citizen the ability to give their money to the capitalist state. It ensures the fiscal sustainability of the capitalist system. I think that there will be a lot of different wealth tax links like this, which make this version of the disad, if you can find uniqueness for it, really strategic to read as a version of the capitalism critique on this topic. I also think that people will critique economics. We haven't had an economics topic like this in a second, but I think that people will read lots of arguments not only about gender and about feminism, but there are lots of critiques that talk about economic rationality, because the economic system is really complex, and the way that we rationalize and think about the world in terms of economic certainty and fiscal certainty and productivity normally is not the best way of looking at the world. I think that a specific version of this might be a criticism of debt. A lot of Moten's literature talks about debt and credit and how that works. I think with liquidity, that might be a place where you will get a lot of ground for the negative to make these debt style of arguments. I think another criticism that could be read on the topic is just like the old school biopower critique. Maybe you read this as a link instead of like a wholesale criticism, but I think that the idea of tax law, of legal duties, of legal authority to redistribute things gives power back to the sovereign state, the sovereign power, which would make the biopower critique seem like a really strategic link argument to make on this topic. I think for that same reason, the normativity critique, anything that would critique legal systems, seems to be a smart angle to take as a critical debater, because if the affirmative is forced to do tax law, that seems like really low-hanging fruit to generate different links to different critiques. I also think that Baudrillard, if you are willing to read, invest the time in it, that this is a phenomenal topic for Baudrillard, because the wealth that these billionaires, millionaires, centimillionaires have is fake. It's not real. It's unrealized. It's in fake little stock certificates. Is that really the economy? How does that work? And I think that all of these things are just signs and simulations of how the economy functions, rather than being encompassing of the economy itself, which I think means a lot of different arguments to be made for Baudrillard. I also think that you might see some teams read some cosmopolitan arguments on this topic. The idea would be that the wealth tax is a form of national solidarity, where wealth is redistributed along national lines, which pits us, the nation, against them. Remember that taxation is a social contract with the state that forms an obligation to the state. That tax creates an us that is bounded to the topic via the taxes. I think that this might be a form of nationalism that would be a source of a cosmopolitan critique link. I think that an alternative that just would be radically open to everybody would be really strategic, given the way that this topic is written. I also think that just the old school coercion I don't know if this is a critique, it's more like a turn without uniqueness, or a disad without uniqueness, but I just think that taxes are really coercive, and there's a lot of literature that says that coercion is bad. Now, maybe you shouldn't read cards from 1974, but it wouldn't shock me. The last two critiques that I want to talk about are settler colonialism and anti-blackness. I think that both of these critiques are potentially really good on this topic. Let's start by talking about settler colonialism. I think that the wealth tax would be an example of the government securing its share of wealth that was generated on indigenous lands, and I don't think that the government would be beholden to that. The affirmative would be an example of the government securing its share of settler appropriated wealth. The other problem with how the affirmative functions is that the affirmative is a move to give up money rather than to give up indigenous land, which I think would be a move to settler innocence, which would be a place that a lot of negative teams could generate a link. I think that before I move to anti-blackness, I think one thing that's worth noting that's interesting about tax law is that the Internal Revenue Service, the IRS, collects no race, ethnicity, or indigenous data and has no statistics on that data. I was listening to a podcast or a book over Spotify that was The Whiteness of Wealth, and it talked about this, and I think that this is both an interesting book to read if you are going to say anti-blackness, but also just has a bunch of interesting information like this that I think will be good for critical debaters, because it's going to allow you to make your links really specific to this topic. I think that anti-blackness is a really good example of this, where first of all, you have tax policy that's just built on whiteness. If you look at Article 1 of the Constitution, where tax code is, that is also where the 3/5 compromise is. If we also look at just tax policy in general, tax policy is generally just made with white people in mind, even if it isn't necessarily meant to like negatively impact black people. It is definitively meant with white people in mind, which I think is going to be an interesting link to the topic. I also think that a lot of anti-blackness teams are going to talk about how the tax just reifies the government. It doesn't change how the government does anything. So for instance, a lot of government policies reward good recipient behavior. There's a lot of welfare tropes about people who receive welfare being lazy, people who do the or people who have wealth being hardworking. I think a lot of these ideas are going to be places where anti-blackness teams are going to be able to generate a lot of links, because typically when we have had these type of inequality debates where revenue is generated for the government to do social services, public services, that this ends up being a place of contention because that tax doesn't change how the government does that welfare policy, where a lot of teams in the past have read links to anti-blackness. I also think that there are, just sort of your generic links, but I think there's also a lot of specific links in terms of when you look at the sale of property. Black property is maybe undervalued. If we have a liquidation scenario for the wealth tax where people have to sell their wealth, maybe that value in stock is valued less for a black person than it would be for somebody who is white. I think that all of these are interesting ideas to think about when you are trying to construct and make your anti-blackness position specific to this topic. Now that I've finished talking about critiques on the negative, I want to finish the substantive portion of this lecture by talking about some potential critical affirmatives. I think that the big critical affirmative that lots of teams could potentially read is the capitalism bad affirmative. I think that there will be a lot of different versions of this. I think a popular version might be a super radical wealth tax that really, really taxes wealth and makes it so that there are not a lot of wealthy people. This would lead the world, or lead the United States, to be more socialist because there would be less variance in income. If we look at the redistribution of wealth as an idea, that idea is very anti-neoliberal. I think that you will have different versions of Marxism, whether it be pure Marxism, actually reading cards from Marx, to black Marxism, and all types of different ideas of different ways in which capitalism can be read on this topic. I think that you might even see a radical wealth tax that talks about destroying oligarchy and how that impacts and intertwines with capitalism. I think that there will be an anti-blackness affirmative that talks about reparations. I think that this is definitely in the literature for how a wealth tax should just be used to give reparations to black people. I think that there also will be an anti-blackness affirmative that criticizes how welfare in the past has worked. If we look at welfare policy, anti-welfare redistribution really actively produced a lot of racialized bodies. I already talked about how the IRS collects no race statistics. This means there's no taxpayer data on race, and I think that a lot of critical affirmatives are going to try to leverage this to make an anti-blackness affirmative. I think that there might be another version of this that uses Moten to make different debt and credit arguments for the wealth tax as well. I think that the final critical affirmative that I see happening is the abolition democracy affirmative. I think that this seems intuitive to me. I was looking for literature on it and it didn't seem like it was as good as I thought, but I think that a lot of teams will go this direction because that money that would be gotten from a wealth tax could be used to do the things that people who advocate for abolition democracy talk about. I just haven't seen the cards yet that say this is a non-reformist reform or the likes of that. So that's the critical perspective on the topic. Before I finish up this topic lecture, I just want to give a couple final closing thoughts. The first thing I want to say is that this is not the living wage 2.0 topic. The number one thing that I thought when I saw this topic, I really thought nuclear was going to get chosen, was, oh no, we're going to have to debate living wage for 2 more months. I'm really sick of it. The literature doesn't seem good. The more I researched for the topic lecture and for the classes that I teach, the more I thought that this topic is just diverse. There's good literature, and there's just really good literature on all of the different styles and metas that different debaters take, which I think that will lead to this topic being a really good, robust topic. The second final thought that I have is there's already a lot of briefs, or at least I saw that the Kinky brief was already released. I used some of that while thinking about this topic lecture. If you want to go to the description below and just download some evidence, I'm going to link it there so you can get a quick head start on the topic. Some things to think about that I just haven't been able to wrap my head around yet. First is that the literature is not super comparative. The people who think that the economy is destroyed, the affirmative doesn't really have a great answer to that. The affirmative authors who say inequality is really reduced, the negative, I'm not sure there's a lot of defense to that. The problem with the topic as a whole, though, is I'm just not sure it's that much money. It seems really noble to tax billionaires and wealthy people, but if we really look at it, it's not that much money. I want to say Elizabeth Warren's plan was like $3.5 trillion over 10 years. That's like 10% of 1 year of the federal budget. And all of these numbers assume the best case scenario, and our deficit, our budget, all of those things are huge. And I think that that is something to really contemplate as you start to put together what you want to say on this topic. The final thing that I have to say is I think that this topic could get really complicated if former President Trump becomes the 47th president, because I think that that would change how the topic is viewed. I don't want to get into that right now, but I think in terms of you viewing the topic, this might be something to think about, because it is likely that the election result is going to be decided before you go to your first tournament on this topic. Now, if we look at this from like a fiat time perspective, maybe the wealth tax happens before former President Trump would become president again. But I think that this just brings up a whole bunch of issues that would be debated if things down the road happen one way or the other. So hopefully you enjoyed this topic lecture and you found a lot of the information useful. I hope that you take all of the different facets, whether it be the value criterion, the history, the disads, or the critical perspectives, and use that in the upcoming months to debate the wealth tax topic. Thank you, and I'll see you in a coming video. Bye-bye.